You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, last week we looked at earnings in Tesla, and actually, as we speak, they should be announcing them. I have no idea where they're at, but we are taping. The market has just recently closed, and it is the 24th of April. We had to tape this episode a little bit early because of the Options Industry Council, which is the big to-do down in Miami this year, once a year. Usually I am there with Mark, and we're taping some Options Playbook Radio, but this year I'm unable to make it. But still, that means that we have to tape Options Playbook Radio a little bit early. And I preferred to do this just because we have Amazon announcing earnings. So this week it was just all over the place with earnings announcements. Basically, this is about the only week of the market that you probably have to pay a ton of attention because you had Microsoft today, Chipotle, Facebook, Amazon tomorrow, Tesla this week. And those are just the ones I can think of off the top of my head. So right now, officially, the market has closed. The date is April 24th. Amazon is announcing after the close tomorrow, which I always love the fact that Amazon manages to post their earnings on a Thursday, which means that the option contract has 1 day to live if you pick the shortest term expiration. So we're going to go back to the old standby. It seems like every quarter we like to look at an Amazon skip strike butterfly. It's only because of the dynamics of the entire trade. In Amazon, I wouldn't want to do a skip strike butterfly if they announced on a Monday. And here's the whole reason why. Amazon is a $1,900 stock. It has a ton of premium just because of the fact that it's trading at a valuation of basically an index. And then you throw in earnings and you pump up volatility. And that means all of that has to go away in 1 day if the option contracts are out of the money. So you get a ton of premium because 1 day's worth of time premium in that big mix of information about the pricing is worth something. But it's got to go to zero if they're not in the money at the end of trading tomorrow, or on Friday, I should say. We're taping this on a Wednesday, and that's when we normally tape. So this will be posted, I'm thinking, somewhere around May 2nd. So either it's going to be posted on the 2nd or the 1st sometime. So we're a week after the fact. Okay. So with that said, in a week's time, you will listen to this and be able to look back at the Amazon chart and see what happened. But as always with Options Playbook Radio, nothing's ever meant to be a recommendation. We're going to do the skip strike butterfly because that's what we normally do. That's what we like to do around Amazon. And it's all not about just the stock Amazon. It's about the dynamics of the trade. And that's our whole goal on Options Playbook Radio, is to basically trade via the Greeks less than the forecast for the underlying. I have no idea where Amazon's going to go, and that's not my outlook. The reason why we're doing this trade is because that time premium has to erode. And if we're correct on the forecast, we go way out of the money. And if that option, if the stock just happens to land on your short strike of your skip strike butterfly, you hit a home run. And if not, the risks are minimal. And that's the whole goal of these advanced strategies and why we talk about them inside the options playbook. So let's get to the trade. Okay. Amazon closed today at $1,901.71, $1,901.75. It was down $22.02 on the close today. The date is April 24th, and this is when we're taping Options Playbook Radio. We look at the long straddle, as we always do when we're trading anything around earnings. And long straddle means that we're buying the most at-the-money call and the most at-the-money put. So that would be the 1900 strike. Now, I would prefer to do this on the day that they're going to announce as close to the close, but we're taping the radio program a day before that. So with that said, considering that, it says the straddle is trading at $77.50. Now, that's important to us because that's basically the market expectation. It could go up or down. It never has regard to direction. About, let's call it $77. So we're going to go further than that because our risk is going to be on the upside here. We always like to look at the call. We're going to be bullish mainly because stocks have a tendency to go up a little slower than they do go down. And our risk is if we get a huge opening, a big gap opening, that's when our risk comes in on this strategy. So we're going to go farther than the expected move. The strike that we're going to buy is going to be the 1990 strike call. We're going to be using the shortest term expiration because, as I said, they only last for 1 day. We want time premium to come out if we're wrong or if we're right. We would like time premium to come out of this trade. So we buy the May 3rd, 1990 strike call. We're going to go 20 points up to the same expiration and sell 2 of the May 3rd, 2010 calls. And then we're going to skip a strike, which would be the 2030 call, and go another 20 points to the 2050 call. By doing this, we're basically embedding a short call spread inside the standard butterfly, if you will. And we're hoping that we bring in enough of a credit on that short call spread to pay for the butterfly. And in this instance, the markets are closed, but we're showing a midpoint of around 72 cents. Now, don't forget, there's a lot of commissions in this trade, and you want to add that in because there's 3 different legs and a total of 4 contracts to do a 1x2x1 skip strike butterfly, also known as a modified butterfly. But I do think that that name should change because it does not tell you anything about the actual strategy. What we're physically doing in this trade is we're taking a standard butterfly. We're going to skip the highest strike on this long call butterfly and buy one further out to make that hedge a little cheaper. And hence we can get a butterfly done a lot of times for a net credit to the account. All depends on the underlying and all depends especially on volatilities. This is when earnings comes in and adds to some of that volatility and makes the trade a little bit more interesting. Okay, so like I mentioned, we basically embed a credit spread in here by skipping that strike, and it's a 20-point wide credit spread. So the maximum risk is that 20 points. So $2,000 is the risk of the trade. The maximum upside is also $2,000. The net credit received is 72 cents. And so on the upside, you can add that 72 cents. On the downside, you can subtract that 72 cents or $72 on the total risk of the trade. So what is our outlook if we do the skip strike butterfly? Well, this is where it's interesting in that if you're dead wrong on your forecast, which we really don't have a forecast here. We're doing calls because calls react better to moves in the marketplace than puts do. And bottom line is volatility comes out on up directions and it usually increases on down directions. And we want volatility to come out. We want these options to erode. So if Amazon comes out and announces earnings and the market receives them as poor and the stock goes down, well, all of these options will expire worthless. And for your troubles, you'll get that net credit to your account. You will keep the $72 for every 1x2x1, or you can think of it as 72 cents for every butterfly that you put on. Now, on the upside, the ideal scenario would be that this underlying would open about the expected move, which in this instance we called it $77, and then drift upwards towards our short strike. Our short strike was the 2010 strike, which is 108 points away from where the current stock is at. So that would be an ideal scenario, and that's a very possible scenario. It's probable. The marketplace thinks that a 77-point move would be a quote-unquote normal move, and hopefully just hope that it drifts on up throughout the day and ends up close to the 2010 strike. That would be the ideal scenario. And if it ended right at 2010, right at expiration, we'd put this trade on for a 72-cent credit, and then we'd also sell it for a 20-point credit, right? Because the best thing that it could be is the best case scenario here is that the 2010 option contracts go away along with the 2050 option contracts, and then you're just long the 2090 call, which should be worth about $20. Okay, where's the risk come in? Well, the one thing that's nice about this is the risk really hits us mainly if Amazon were to gap about double what the expected move is. So in this instance, the risk starts hitting us at 2030. That's where we really start to feel the pain at expiration. I'm going to emphasize expiration because anything can happen during the day, but at that Friday expiration, that 2030 in this instance means that the market is, we said it was 108 points away, so it's 128 points, which is almost double the expected move before we really start to get hurt on the trade. Now that depends on when it would reach that level. But then from 2030 to 2050, we have a lot of risk there. We have a 40-point wide on the short spread side, and we're 20 points wide on the long spread wide side. That's where the math comes in. So what's the moral to this story here? Well, with Amazon, and you're doing this type of trade, the risk of the trade is really on the gap opening. So there's not a lot of risk. There's only one big scenario that it can hurt you. But if it does happen, it can hurt you real bad. And it has happened in Amazon. And if you trade these enough, eventually it's going to happen. So bottom line is that's where your risk is. It's on the gap opening. The market opens flat, opens down, opens up a little bit, opens up the exact expected move. All those scenarios are good for this trade. Now, with that being said, the upside is very limited too, because you're looking at a very big move to get to the point where you might be able to max out on the trade. So the risk is one huge gap opening, and there is risk there. But with that said, that's only one scenario that can happen. The reward only happens if you can get within that sweet spot. You need it to open more than the expected move, and then you need it to land in a 20-point range between 1990 and 2010. That's where you really want it to land. You can even move that up higher because you got a little bit of a buffer if it goes beyond 2010. But there are many different scenarios where this trade is okay. But, that's nothing to write home to mom about because the odds of doing it are low, the risks are low, but that chance that it just opens up double the expected move and you can't get out of the trade, that prevents people from doing thousands of these, right? And putting up all the margin, because in Amazon it's feasible. So you have an interesting underlying. It's a $1,900 underlying, and adds premium. They always seem to announce on Thursday, the day before the Friday expiration of the weekly option contract, or even the monthly, depending on what week the quarter announcement's going to fall on. And that is why this trade is interesting. And once again, on Options Playbook Radio, we're never talking about trades as a recommendation. We're talking about learning. And my outlook on Amazon, or where we're at, doesn't matter at all. We're looking at the dynamics of the option pricing, and we're trying to take plays that are mentioned in the playbook, and when might that play be an interesting play to do on this particular underlying stock. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.